Okay, well, we are ready, so when you're ready.
There's some online, huh?
There's some online, cameras there.
Good on. Good to see you. I got a call going right now.
That's great.
I know Sharon and Elizabeth can jump in.
I'm prepared.
Other agents here too. I told them kind of behind the scenes, here, behind the scenes of the lending world, we're going to be in every office.
Sure.
So, you know.
Okay. I think I get it.
Are you going to need to share the screen or show anything online? Or?
I don't think so. I certainly can, but I don't think I need to.
Okay. If you do, Kristen is right here, and she can help. If you need to get online or anything, there's a share the screen button.
Okay. Oh, jeez. Enough. I guess, do I need a mic? I don't think I do.
No, we can hear you. They can hear you.
You guys can hear me okay at home?
Yeah.
Melissa and Stephanie?
Yeah.
Great. I think we'll wait. Are we waiting just a couple more minutes for other people to show up, or do you think we should start?
Yeah, I think we should start. Yeah,
Okay,
might as well.
let's get started.
People will jump online and stuff too.
Okay, great. So I'm happy to be here. Again, my name is Mike Points. How are you? Good. Mike Points with Central Coast Lending. I'm a real estate banker. That's what I do. I do multiple families all the way down to single family residences for homeowners, investors, LLCs, families that want to buy second homes, et cetera, et cetera. So without boring you in all those details, I kind of wanted to start what would be the beginning of a series of educational meetings today with regards to lending and financing and why that's important. I think that I could go on and on and on, almost have a textbook to go through this for you guys, but that's really boring. What I understand is that most of the agents in this room are relatively new and don't have a lot of experience with dealing with a lender before the transaction or after the transaction. So I'd like to, before the transaction and during the transaction. I'd like to focus today mainly on before and then get into some reasons why that'll make life easier during the transaction. Because I truly believe that you agents, once you're in the transaction, you've done a lot of the work. It's now up to a transaction coordinator to help. It's now up to a lender to take over and make sure this thing closes, this deal closes. I think a lot of your time has already been spent with the customer, the buyer, if you will, in this scenario. And you want to spend more time working with new prospects, new buyers, maybe their referrals, because they're in transaction talking to everyone about, we're getting a house. So I really am going to focus a lot on, somewhat of a long intro today, but I'm focusing a lot on why it makes sense before you get into transaction working with the lender so that you can feel good. The worst thing is following up when you really don't need to on something like an appraisal. Why isn't that done yet? Can we remove contingencies? Why haven't I heard from you, lender? So I'm going to explain some of those things today. Before I get into it though, I think this is a good time just for you guys to do a little Q&A. Maybe you've had something weird recently in a transaction, or you just have something that's bugging you, or you're not quite exactly sure how to introduce a client to a banker. Does anyone have any questions at this time before I keep talking? Anyone at home?
Can you hear me?
I can. Hi.
Hi there. Okay, so I'm in a transaction right now, and the appraisal was ordered over 2 weeks ago. It was supposed to be done today. I believe was our deadline. We got an email last night that the appraisal has been kicked back until this next Friday, tomorrow, because the appraiser cannot find the permits for an add-on, but they have been archived. It's not that it wasn't permitted, it's that the permits have been archived. So what could happen in this transaction now? We're getting ready to lift contingencies. We've come this far, and of course I don't want to hound the lender because he's trying to do his job, but at the same time, what's gonna happen?
That's a great question. So what, do you have any idea, how many bedrooms is this property?
This is a 3-bedroom, 2-bath, and there was a detached garage, and they attached it with a breezeway. And it's an older home, built in 63.
Yeah. Okay, and so really the permits are for a fixed breezeway to the garage?
Yeah.
Yeah, so I mean, honestly, I've seen this happen a lot. A lot of times, I'm gonna be honest with you, I think this is one of the reasons that some of the agents I work with here, Linda and Dave, like me. It sounds to me like an excuse and the appraiser's behind. I don't wanna accuse anyone of that, but really that permit is not gonna make a big difference in your value.
Even if it's an FHA?
I'm sorry?
Even if it's an FHA?
Yeah, the FHA, so what the appraiser, if he's absolutely honest and correct, what he's probably trying to find is that this square footage that he has for the property, there's a variance between what the county has or the city has and what he has from the prelim and what he has in his software. He's trying to clear that up so that he can give the most accurate value to you and because have you seen an appraisal yet, Melissa?
Oh yeah, I'm not a new agent.
Okay, great, sorry. Didn't know. I don't know if I'm smiling at you here. Yeah, I would say this, the lender are they a local lender?
Yes.
Great. They're probably doing the best they can to get that done. I would just email them and ask them if they can see what's called a SSR report. Okay, an SSR report is a Fannie Mae and Freddie report. What that is, it's a basic snapshot of the comps that the appraiser used. So that's Sam, Roger, SSR. Mm-hmm. See if they can let you look at those. They usually get those a day or two before they get the report. So they'll kind of see what the appraiser already thinks the value is. The true report does two things. It establishes value and has all the elaborations from the appraiser, such as near noisy street or the conditions of this property are better than average. That's why I gave it more value. It goes into the full narrative of the appraisal, but the SSRs show comp 1, 2, 3, and 4 were in this neighborhood, and it'll show the value of this home. So if you can get a copy of the SSR, I wouldn't tell the listing agent you have it, but that can give you assurance that at least you're not going to come back, next Monday when you finally get the appraisal report back and you're going to be undervalued.
Mm-hmm. Okay.
If they can't give you the SSR report, then I do think this is kind of what I was talking about in the beginning of my intro. You need to bug that lender one more time to get that back to you. I have all types of things I'm doing today. Today the market is going down again, getting worse for borrowers. So a lot of bankers are probably looking at locking loans. It's important that your transaction, that's, 14 days into escrow, gets some attention.
Mm-hmm.
Mike, I have a question, but I've had a similar situation like this, and if I'm hearing this all correctly, isn't it this being based off of the appraised values being based off of square footage, which they need those permits for to be able to deem that value in that property? And those permits, like in this county, are going to be at the courthouse, and it's registered as livable square footage. If you have a non-permitted dwelling, that's not going to be appraised value to the house. I think if I heard the question correctly, that's kind of what she's struggling with. Is that
Melissa? You don't have a non-permitted garage. You just have a breezeway that has archived permits, right?
It's a breezeway that's been turned into a second living space, and when we went to this, it's archived.
That's what they're wanting to get the appraised livable square footage.
I'm sorry, I didn't hear that all the way through. Yeah, you're right. I'm sorry. And your name is?
It's Ben.
Ben. So Ben is right to correct me. I mean, square footage is what the listing agent is using as a function of the listing price.
And that's where that archiving issue is becoming with the county. I know with what I've dealt with is it's, it could be with the city can have one thing on record, and then the county can have, in their archives can have a whole nother livable square footage, even if it was done, 20, 30 years ago. Right. It can be registered, and the city will actually override the county, as crazy as that sounds.
Right. Melissa, is this like bedroom number 4 or family room number 2?
Family room number 2.
Yeah, so let me tell you something else, okay? I'm gonna take some liberties here, mainly because I've seen a lot of transactions. That extra living space doesn't really even get much value from the appraiser. So do you know, have you had a conversation with the listing agent? Did they price this out on a square footage, cost per square foot basis? Do you think that they actually valued that family room in their price?
It's valued based upon an appraisal that was done 9 months ago when it was in escrow before, and the buyer decided to walk and leave town. This is in Bakersfield. I'm in Bakersfield right now.
Oh, okay, gotcha. I mean, 9 months is technically no longer relevant to a bank, but that is usually a good indication. The interesting thing will be is, you know, you get 2 opinions of value. You have a different appraiser. The value that they use, have you had a copy of that old appraisal?
Yes, it's attached to the MLS, actually. I don't have it in front of me.
Sure. So, but you've seen it.
Mm-hmm.
Did they,
So we came in, I got this under contract, $15,000 less than what the appraisal value, with an additional $7,500 in,
seller credit?
yeah, seller's credit or closing, yeah.
Right. Yeah. Okay.
So
I mean,
we're good. I'm not really worried about it coming in. I'm sure it's going to appraise. The point is, why is it taking so long? And can he hold up our transaction like this?
Yeah, I actually share your frustration with this. It's just as hard. I know this is hard to swallow right now. I'm empathizing with you, but it's just as hard for the lender to not have it back, because we really want to share that information. It's the number one thing you're probably waiting for from them. It is a viable response from the appraiser. They have issues, even in major cities where you can go down and get the permits online right away. They have issues. So I wish I had a better response for you on exactly what to do. If you could ask that lender to see if they have had a copy of the SSRs, then that would be nice, because again, that's going to help you establish what the value is going to be on the report. It won't help you. The appraiser could still put the value came in at contract price, but this report's not completed until, you know, subject to some issues. We see this all the time for smoke detectors.
And then I would have to challenge it, which is another 2-3 weeks out.
I mean, I don't think appealing is not a good idea. It's a long, vigorous process, and you have to offer 3 other comps. The subject to stuff is just going to be some stuff that you may have to change. You might say subject to final permits, so he could give you the value and everything and still go back and work on the permits and get that done. But if he can't find them at a certain time, he has to meet his deadline. If it's due back today, he does have 5 hours.
Mm-hmm.
But yeah, the only thing I really could add value with is see if that lender can offer you up what the SSRs came back as, because those are both from Fannie and Freddie and done on every file, whether it's a VA, FHA, or conventional or jumbo.
Okay.
Yeah, good question. I wish that's tough. What I would say is, for those of you who don't have a lender relationship, it's really something to form. I honestly think it's good to have 2 to 3 lenders, because like next week from Tuesday to Friday, I'm going to Yosemite. You know, one of the biggest pains in the rear is you finally got this buyer to love this house, and grandma and grandpa are going to give them money, and you want to sit down and get a pre-approval done, and you can't reach me. So I recommend having 2. What I offer to all of my agents is a thorough pre-approval. And what that means is, you know, the loan application requires verifiable income, verifiable assets, credit. So I have to look at pay stubs, retirement income. If they're self-employed, I have to average over 24 months what this person's income is. A lot of self-employed people, they're like, oh yeah, I make 12 grand a month. That's what I bring in. But they tell the IRS they make 4,800. Well, guess what I get to use? I get to use 4,800. And that's not a lot if they're the breadwinner in the household to go buy a home, because I can only offer them up to 50% of what their net income is for a housing expense, mind you, all their car payments, those types of things.
So no more stated income.
Stated income is no longer a conventional loan, meaning like there's not a lot of shops that'll just do stated income. There are stated income loans. They're going to be much higher interest rates, and you'll need to prove things through bank statements. Now, you won't just come in and write, I make 120 a year. You'll have to show an average deposits going into your personal accounts for the last 12 months. That's how you state income now. So even that's quasi-verified. It's a hybrid. Hard money lenders exist, and they exist in this marketplace because they really don't care what your credit is. They want 35% down of whatever the asset is that you're going to purchase. And they'll also cross-collateralize. So they'll do, I own a house here in Utah, free and clear, but it's only worth $200,000, and I own a house in San Diego. I own 50% of that house. They can lean on those two houses to get your 35% down as collateral. They're still going to want 10 or 15% in cash for the deal that you're writing up escrow for to buy here, because they really like to see the borrower have some actual skin in the game, mainly because it's difficult and there's a process to claw back and get assets from the Utah property, claw back and get assets from the San Diego property. They feel that the borrower, the owner, will want their 10 or 15% back, whether the market's going up or down, and they'll sell, at which point hard money guy gets paid back. I digress though. The pre-approval process is so huge. Sometimes new agents get frustrated with me because they're meeting someone at an open house. Hey, I got someone right here. Like, this is amazing. I thought this never happened. But this guy wants to buy this house. Can you pre-approve him? It's not smart for me to just ask him, what's your income? Sure, let me send that letter over. What I do is I will speak with them. I'll give them confidence of what their payment would be. I'll tell them the things that they want to know to still be serious with you. And then you can build the rest of the rapport you need with them. Get them over to me Monday, and I'll get all the documents from them. Linda Moser is here, and she can verify that I do a full loan proposal for every house. If you like 123 Main Street, they send me an MLS. Usually they'll have an appointment with Linda at 5 o'clock. They'll send me the MLS listing at about, 11, 12. Hey, we're looking at this house today. I'll draft up a proposal with what I know they want to put down, what the monthly payment is, what the current interest rate is, and they see that before they go see the house with you. Why do I do that? Because I don't open transactions I can't close. That is a nightmare. And you guys at home, you've all had this. You're 2 weeks away, a week away, knock on wood for you, Melissa, and all of a sudden the lender's like, hey, we got a little bit of a problem. Some of the income that I thought was there is not there. Is there any way we can get the borrower to put down another 5 or 10%? Or I might need to call the borrower's brother and get them to hop on the loan. And that is a situation that I take care of in the first meeting. Hey, here's the problem. We have not enough income. You've shown me W-2 income, which is great, but you've only worked in this field for 18 months. And the guidelines state that you have to be in this industry for at least 24 months for our underwriters to feel comfortable for this income to exist.
What guideline is that under?
Say that again.
What guideline is that under?
That's a guideline set by Fannie Mae and Freddie Mac. It's a conventional, and it's also
So it's two years in the trade.
Yeah.
They have the W-2s on.
Yeah, and so work history is 24 months. Like, you could be a clerical person over here, and you could go into a restaurant business, and you could bounce around back to clerical. As long as you've been working for the last 24 months, that type of work is basically a wage job. So any type of simple wage job, you just have to show 24 months. But let's say I'm a CPA, and I've been a CPA for 18 months, and the money's good, and I'm tired of renting, and I want to go buy a house. And I come and sit down with Linda and say, look, you referred to me. I make about $7,800 a month. I think I can buy a house here in Arroyo Beach. Linda's first thing she's gonna do is say, that's great. Can you please chat with my lender, Mike? And I'll point out, you've got a 6-month gap here where I can get you into escrow as long as that first mortgage payment is on the 24th month, so month 22. So we're only 4 or 5 months away. Or you can roll the dice if you don't believe me, and then when you get to that last 2 weeks when the underwriter's going to finalize everything, they're vigorously looking through every piece of my loan application. They're the ones that give me the green light and say, go draft these loan docs and sign them. And when you close escrow, we'll buy them from you. We'll buy the loan. And no one in their right mind should sell a loan that can't be bought. That's one tricky scenario. Another thing is, and I can't tell you how many times people say this, oh yeah, I went on Credit Karma and my credit score is 740. Yeah. Okay, well that's great. I think that's great. I'd like to pull your credit because right now Elizabeth wants us to write a pre-approval letter that is going to go to another listing agent that is at this price is probably going to counter or accept your offer. And what that means is now you're in a position where all that time you've spent, all the relationships you've been building, all the houses you went and showed them, you're finally going to need a payoff and you're going to get into escrow. And my job is to make sure that I don't call you a week later and say, hey, we got a little bit of an issue. And so the training today is this. I think that you guys I would like to tell you and even email everyone in this room the list of things that are usually needed, not because I want you to get those for me or a person like me, is so that you can understand that there is a pretty thorough process that needs to be done, and at least a pre-approval, if anything, before you spend your time to go show them houses.
Yeah, and I just have to give Mike props because he does do a thorough job of getting the documentation from the clients and then writing up the proposals for the properties they're interested in looking at. So when I do make an offer and the listing agent's questioning, if they're financially solvent, it's like I have no problem saying yes.
Right. Yeah, and I think so. Stephanie, are you a new agent?
2 years.
Okay, good. Have you had a scenario? I'm sorry, I'm picking on you. Have you had a scenario where, an agent, or excuse me, a loan officer met with your clients and then wrote a pre-qual letter or a pre-approval letter that, got accepted, and then did you ever have any issues with?
No, I haven't had any issues like that yet.
Oh, you're very lucky. That's good.
I have.
That's good. That's good.
And it wasn't Mike.
Well, I mean, this whole thing. So my reason for being here is I want to answer questions, but I also want to let you know too. I don't expect you guys to use me. I'm really here because I like helping agents get better at the process. I just received an offer right before Labor Day. I got forwarded an offer that was accepted where Quicken Loans, Rocket Mortgage was the lender. Okay, it was a VA loan. And right off the bat, what do you guys know about a VA loan for down payment in this room?
Zero down.
Zero down, right? And on a $389,000 home, what do you think the closing cost would be?
12 grand.
It's about 1.5% is usually closing costs. 1.5% of what the total loan amount is. Okay. So he's got zero down, 389,000, and his EMD was 12 grand.
His EMD.
His earnest money deposit was 12 grand.
Why?
So the lender at Rocket Mortgage, they do a terrific job capturing market share, told the buyer's agent, brand new buyer's agent at Keller Williams, 12,000 is what you should do because it'll look better to the seller. So this agent just said, go.
The legal cap is 3.
Right.
They don't have to put any money down because they're veterans.
EMD money is necessary in any contract. So, they could do, for VA, I usually recommend 1%. this guy should have put down $3,800 or $3,000. I'm telling you this because right away the guy is panicking because he has $7,800 in his bank account. He doesn't even have the 12 grand to go put down. So right off the bat, between day 1 and 3, I'm speaking to the listing agent, giving them confidence that I've pre-approved the loan, and talking them through like, hey, this is not going to happen. Like, let's draft an addendum that says $1,500 due, and we'll put the rest of the amount that's due total, cash to close, in when he removes his contingencies. We'll just deposit it all there. And the reason the agent agreed is because A, I think he really did want to help a veteran, but B, it's because a lot of times these new agents get not foreign, but out of the area, rocket loans, or, you know, some on the line on bankers, Sierra Pacific loan officer that messes up the transaction. They're just kind of used to it. Okay, well, let's figure this out. We're already in contract. It's embarrassing to my client to go back on the market. I feel like you guys have various experiences. What is your experience with drafting the finance portion in the first page of the RPA? Not the BIA, but like what the earnest money is, interest rate, what percent it is. Have you guys, is that difficult for most people? Do you usually rely on the lender, or do you just get a calculator out and do the math yourself?
Calculator.
Calculator, is that you, Steph?
Yeah.
Okay. How about you, Melissa?
Calculator.
Okay.
And then I ask for my pre-qual to match my my RPA.
Okay. Okay, good. I typically like to draft, I feel like it's the lender's obligation to give you some notes on that. Not because I think I'm taking over on the offer. You give me the offer price, I draft what the loan amount's gonna be, what the interest rate is at the time. Obviously, you've got to touch on what type of loan program it is. Do you usually know what type of loan program it is before you draft that offer, Melissa?
Yes, I know what kind of loan they're going to have before the lender knows, because they meet with me before they talk to their lender.
What, is that an approach you want to get away from, or is that something you like?
It just seems to be happening over and over again. So therefore, you know, if I have somebody with a jumbo loan, I'm going to send them to this person. If it's a, you know, first-time buyer and maybe the price on the home is really low, I'm going to send them to this lender because this lender doesn't mind working for a $300,000 home. Just kind of, you know, so that's why it's really important to me to have a relationship with several different lenders, and I know how each one of them works.
Got it. Yeah, that's I mean, you're doing a significant portion of our job, which I think makes you a better agent. It just takes a lot of time, right?
Oh, yes.
Time consuming. And, you know, I'll tell you this, and I know you guys can second this. It seems like in these transactions, the buyers hear what they want to hear, and they tend to forget some of the warnings that we give them. And I find that to be true so much when you talk about things like interest rate or what the total closing costs could be. I believe that sitting down, I always welcome agents to come into my meeting and sit down with me the first meeting. It does take about an hour, but I would say that the number one thing that you want to get from a lender as soon as they have that meeting is a discussion and or an email that tells you not only the price range, but why we're going to do FHA, you know, why we're going to do 3%
Yeah,
down.
that's what I was gonna say. That I did a little backwards for Melissa, but it's like I don't discuss what kind of loan my clients are gonna do. It's like that's for them to talk to you about.
Right. Well, the reason I say that, Melissa, is I really do appreciate what you do. I can't tell you how many agents send me leads, and it's because they don't know, where people have like 3 or 4 grand in their bank account. And I'm like, I'm sorry I have to tell you this, but you don't have enough money to even be talking about real estate. Is there something I'm missing? Are you going to get a gift from grandma or grandpa? And, no, I just want to stop renting. Okay, well, I get that. I do.
Yeah, but isn't there some first-time home buyer initiatives right now with 1% down, and you get 2% on the
There's
backside?
different programs, so that's why I'd rather they talk to the lender.
No, I understand that. I was talking about what other options, even if somebody that has 3 or 4 or 5 grand in the bank. I mean, there are incentives right now that you can, 1%.
Yeah, there's a grant program called Golden State Platinum Grant, Golden State Platinum. I'll double check the acronym, but basically they're a private entity that partners with certain banks. Okay, and what they do is, like for example, we have a U.S. bank relationship, and GSPA is our resource to get the grant. So we have to fill out an application for this individual to get a grant. So it's income bracketed. You can't make more than a certain amount of income. You can't make less. And it's also credit bracketed. So you have to have a certain credit score. 620 is the lowest, and the highest possible is 800. But what I would say 850. What I would say is that a lot of people, it's a marketing scheme, really. A lot of people think they can go in and get the 5%. Most people end up getting 2.5%, 3%, and that has to go towards their down and or closing costs. It's so I don't ever disqualify someone just by looking at their bank account, but I try to get into this conversation because the trade-off for your clients, our clients, is that when you take a grant, when you accept this grant money, the partnership between the grant company, the private entity, and the bank is that the bank is now going to give them a higher interest rate, okay? And the commission rebate that they used to give me, the banker, they're gonna hold a piece of that back. And that actually goes back to refund the grant company. So so we get into that conversation of what does this property mean to you, right? How many times do we have that? Is this a first time home? Are you gonna live in it for 3 or 4 years? Are you gonna live in it for 20 years? Because if you're gonna live in it longer than 5 years, the grant really does not make sense. And that's something that I provide to you after that first meeting is, look, the grant's there for them. They have the option, but they're talking about living in this house for 25 years with an interest rate that's half a point higher. That's gonna end up costing them $25,000 more. I get it that we all wanna sell a piece of property. I totally do. I'm never the guy that's like putting up the roadblocks for you to not get into escrow. But at some point, what's the value, Out in Bakersfield, do you guys do a lot of grant programs, Melissa?
Yes, we do. And gosh, one of them was just put on hold about 2 weeks ago, and then was put on hold for only about a week and then reinstated, which was very frustrating. Because you're in the middle of a transaction, then the client gets a denial letter from that lender, then, oh, it's been reinstated, so then you pick up with another lender, but then, because there was already an escrow number with a denial, now they can't go FHA, they can't use this program anymore, so we had to put another person on the loan. It was a mess. Just to get a new file number.
Right.
Once you've been declined or denied FHA, you can't apply.
Under that account number, they give you almost like an ID, 197 dash whatever. And so unfortunately, you have to get a new number and then order a new appraisal. And if you've already ordered the appraisal, they can transfer the appraisal. Did that happen to you, Melissa?
Well, that's what we're dealing with right now. And then we had to order a new appraisal, and now a new appraisal is taking 2 more weeks. What was supposed to be a 45-day escrow is turning into, I don't know, probably going to go over 60 days.
This is the same one you have the permit issue with? Wow.
Yeah, and it's just, I come from the coast, and now I'm selling in Bakersfield, and it's a completely different ballgame. I'm used to doing conventional and jumbo loans, selling homes to those type. And over here, you take what you can get. And if you're going to sell a $200,000 home, or you're going to sell a $600,000 home,
yeah,
it's a learning process as an agent.
Indeed.
So therefore, Linda, yes, I build the rapport with the client, and I talk a lot and want to know how many homes they've owned, when was last time they owned, how much they have in their bank account, how long they've been at their jobs, what are you looking for in a house, how many people are going to reside in that house, are they all related to you? Yeah.
Yeah, it's so I don't dislike the grants. I think they're there for the right reason. What Melissa's explaining is they run out of funds, so funds are put out into the market from this grant company because it's a private company. they run out of funds in certain zones and they wait for those banks to kind of replenish them with the overage. So they'll hit these dry spells where like, sorry, your file was approved, but by the time you came to get money, there's no more, you know. We are at the bottom of the barrel. And then I think what happened, Melissa said within a 2-week time frame, I guess it came back. They do work well, the grants do work well coinciding with FHA loans because, you know, 3.5% down, you can get a 5% grant. That pretty much is your down payment and your closing costs. Borrowers walking, putting no money down. We have a product that's called a Home Ready and Home Possible product. So Home Ready is produced by Fannie Mae and Home Possible is produced by Freddie Mac. 3% down conventional loan. Okay, the 3% down conventional loan is a product that works really well in these condos that don't accept FHA. You know, and every one of these loans is required to review. How am I doing on time, by the way? Do you guys usually go right till 1?
You start. Yeah, roll with it.
Okay.
You know, I'm not going to get hers.
I don't want to take your ladies at home too much of your time if you need to sign off. I think that what I was trying to get at is Home Ready and Home Possible. What I have to do is I get the subject property's address and I run a quick search. I have a great website for that. Super easy. If any of you want that website, it's open to the public. You can put it in. Melissa, it might be something you like because you do this kind of upfront work. It shows you, it's really cool. It shows you the little territory that the HUD department of our government has zoned this property in, and it has an income maximum limit. Okay, so the maximum income that a borrower can have for this 3% down program is like $64,800. Okay, that's not a lot. Unfortunately, out here on the coast, they're probably going to be making more than that and not being able to put the 3% down. But what's really neat is in every county, there's a couple of these zones that have the 3% down is awarded to them, but no income limit. So the borrowers can make $150,000 and only have to put 3% down. Okay. There's
why
more.
would there be a cap? I don't understand why would there even be a cap on it to begin with, as far as, you know, the whole lending game. I don't get that.
The program was put in place so that we could have basically create more affordable housing for buyers that want to buy homes in certain areas. And truthfully, it's also another way for us banks to generate more business. I mean, a lot of the conventional Fannie Mae and Freddie Mac are companies. Make no mistake, they buy loans and sell them on Wall Street.
So they're trying to weed out the investors?
Well, FHA is not Fannie Mae and Freddie Mac. Now, FHA is a separate branch. It's the, you know, of the government. So they're kind of circumventing. Loan officers are recommending more FHA products because it's 3.5% down. The lowest conventional product after 3% is 5% down. Then it goes to 10, or it goes from, you know, from 5 to 10, any number. But you can get anyone in a conventional loan with 5% down.
Anyone.
Doesn't matter, and I don't have to look at the zone.
FICAs don't matter.
FICAs matter. You have to have better than a 620. Obviously, if you have better than a 720, then pricing starts getting better. Me as a banker, I think you're more, shall I say, you're less of a risk.
Okay. So the rate you could get a better.
Yeah. Below 680, and Melissa, you've probably seen this if you get involved in their credit report. Below 680, it starts hurting them to go conventional. We have a big price hit. They'll go from a 4.25 interest rate to 4.75 just from having a 677 credit score. That's our big break in the banking world, is below 680. Usually there's derogatory items on the credit, and that's what that means. High balances on credit cards. And even if you have high balances paid off, those derogatory items like missed a couple car payments, late on a couple, maybe didn't pay off, like Charter as they exited their last property. You know, they Charter won $130 from them for the box and they never paid them, they never took the box back. Something that says alert, this person doesn't care about who they do business with. May have been 3 or 4 years ago, but derogatories stay on for 4 years. So they may not even be that person anymore financially.
Roll bankruptcies.
Bankruptcies in a conventional market, you have to wait 4 years. So I have a nice derogatory chart that I will actually, I'll actually send you that after this meeting.
Is that the same with foreclosures as well?
Foreclosures are the worst. So foreclosures are 7 years for conventional, okay? You can get into FHA loans. Foreclosure can happen within 2 years.
On FHA?
Yeah.
Okay.
After the filing is made. And a conventional loan with foreclosures is 7 years. For FHA, you can get into, after a foreclosure, you can get in after 4 years for FHA.
With 3%?
3.5. FHA is 3.5.
Interesting.
So what I think is important is, we can go on and on about, there's a lot of matrices in what I do. There's, I like these boxes where you figure out what is my loan to value, meaning what can I put down, what's the least amount my borrower can have. Mortgage insurance, I think, is the biggest topic that you guys could bring up to help convert some of these younger buyers and people that just haven't had a good opportunity to save money. I can't tell you.
Isn't that all based on the LTV?
LTV and FICO.
And FICO.
Yeah, I cannot tell you how many people still think that you have to have 10, 15, 20% down to get a house. That's a market right there that we should be attacking together. If they know that they can put 3% down.
How do we find that market?
Well, I think the discussion is, I don't know how you bring up real estate when you mingle or go to functions, but when it comes up, I think it's important. I think it's our duty to say, the funniest thing is people don't know that you can buy a house with 5% down. Mm-hmm. And mortgage insurance is not the devil. People are like, oh, why would I pay some mortgage insurance company $200 a month when I could just pay my landlord 100% interest? I mean, rent is no equity at all.
Well, then after a couple of years, you can refinance the property after, get a new appraisal, and then that PMI can go away.
You can actually, let's say you bought a house in 2013 right here in Grover Beach, Arroyo Grande, and you bought it with 5% down. Right now, the values that I've seen for in Grover Beach and Arroyo Grande are easily up 15 to 17, 20% in the last 3.5 years. So they don't even have to get a refi. Bankers don't tell them this. All they have to do is get a third-party appraisal, submit that appraisal to their bank, showing that they have the market value versus what their current principal is. If that's 20% equity, the next month the mortgage insurance has to come off by law.
Nice.
They can also at that time say, look, here's what our value is. The bank will say, sorry, you're at 18% equity. They have an option to make an extra payment, pay off to pull down the MI. It's funny though, I've done this calculation a lot where people say, all right, so I'm going to buy with MI and then I'm going to pay extra every month. And I'm going to show me how much extra I have to pay to get to 20% in 2 years. And it's like $20,000 over 2 years. Where if they just paid the $200 a month for 4 years, it would just drop off, right? And they gave $8,000, they gave $9,000 to some other company over 4 years, but they were able to keep 11 grand. So there's two aisles, there's two sides to the aisle, I think that mortgage insurance is a great opportunity for us to talk about. That's something I bring up in my first meeting. Hey, look, we've got your credit in front of us now. It's lower than a 680. It would be really hard for you to get into a house that's $500,000 and not have a payment higher than $3,600 a month because your interest rate's so high because your credit is not good. Let's look at FHA. Here's the rules of FHA. You put 3.5% down. Right now, your interest rate went from 4.75 to 3.875. And the reason it went so low is because you have to take on an upfront mortgage fee of 1.75%. You're paying the government through your loan an extra almost 2% to buy this house. They have to weigh those consequences. Now their monthly payment is about $350 lower for the same house. So people aren't always, I'm not saying brush it under the rug. I'm just saying my job is to help them realize, holy smokes, this can happen. You know, Ben brings me a client. My job is to spin them back with really good options so that you can go look at houses that they're like, we can buy this house. We can buy this house. Then you come in saying, look, your offer isn't that aggressive. It doesn't really work like this. Just because you want to pay $420 for a $450 house, we've got to come in this range. Okay, well, Mike showed us up to $450. We know what that monthly payment is. Let's go in at $440 and see if they respond. I think that's brilliant. Then you get an acceptance and you're not worried like, do they have the money for down payment? Like how is this all going to get figured out? You're getting emails from me like, hey, the disclosures are out. They've already signed them. We're ordering the appraisal. Day 2 or 3. It's not that difficult. I think what happens is we don't want to poke the bear and say like, you know, your payment's going to be $3,600. I don't see where you're getting that money from. You can qualify because these banks are evil. They want you to take on this payment, but you know, would you be comfortable making a $3,600 a month payment? I want them to tell me, no way, because I can make a $3,000 a month payment. Then I come back to you. Sure, we're not at a $500,000 purchase. We're at a $395,000. But now you know if you can find something in that price range, they're ready to write. That's a way better use of our time than throwing offers out at a $500,000 home that's 2 weeks into escrow is going to drop out. You know. Any questions from you ladies at home? Have I bored you to death?
I'm good.
Love that she's on her couch. Wish I was on my couch. So what questions do you have about this pre-approval process? Does it all make sense to you? Are you clear on like what you should expect from your loan officers? No. Okay. When I give a pre-approval, it means that income, credit, and assets have been verified, and the price range that I've given you is a price range that we can close. We also have, I think it's a good time for me to mention this, we have a software that's called an automated underwriting system, and it's called AUS. We love acronyms. Fannie Mae and Freddie Mac allow us to put all the data from the application into their system and press submit, and it gives us a loan approval. Like within a minute, it says this loan is approved. If all this information can be shown, this loan will close. I run that on every pre-approval. So just to give you advice, if you have a loan officer that you've been working with, or if you're a listing agent and you're receiving offers, you should be asking, maybe you probably won't get the actual report, but ask, have you run an AUS? Have you run a DU or an LP? Do you have a loan approval from Fannie Mae or Freddie Mac? So have you run an AUS? Did you run a DU or an LP? Those are the two names. Fannie Mae's system is desktop underwriter. Freddie Mac's is loan prospector. And if they respond yes to you, you're putting them in kind of the hot seat. A lot of loan officers will just run some calculations and say, yeah, this should work. It's a 46 debt to income ratio that we'll totally close that. But they need to fill out the whole application accordingly because the application captures what the guidelines are. It airs out when you don't have 24 months of income in a certain category. It checks out, this guy only has $8,000. How are you going to close when deposit and closing cost is 20? I need to put in, he's getting a gift. And I need to have that conversation with him.
Don't you need to verify some funds or something?
Funds are verified by me before I write the letter. Agents usually are supposed to send over verification of funds for deposit when they make the offer. The best offers made are a written pre-approval letter that states a Fannie Mae or Freddie Mac approval has been made, and verification of funds, and a full offer that's clean with RPA addressing, this is a such and such conventional program, this is an FHA program.
And if you handle it.
In closing though, I really do think that you guys have a tough job. I think your job is tougher than my job. I really do. My stuff's a lot of black and white. And I don't mess around with what the opportunity is that you created. I don't have, I mean, and short of like some family emergency, if you give me a loan approval, in 2 days, I'll either have met with them or verified, a request to approve your clients. I'll have met with them or spoken with them. Gather these documents through our secured share file portal and given them a loan approval that I blind copy you on so you can see the status of what's happening. That is so important to me because Central Coast Lending, we've gained a reputation over the last 9 years of existence, going into escrow and closing and stuff so that you guys get paid. I mean, there are so many deals that you guys get into that you do not get paid on. Or there's so many relationships that you have that you just haven't yet gotten paid on.
So what information are you legally able to disclose to us in regards to a client we send to you so we can evaluate our mind whether we're wasting our time with this person?
Assets, I can disclose to you what their assets are if they have the funds to close. So I can say they do not have enough assets currently, but the father or mother or grandparents have agreed to give us a gift, so we'll be okay. I cannot disclose to you what their credit score is unless they've given me permission. And technically, I can't disclose to you what their income is. That's more of an ethical thing. It's not illegal. But, you know, I'm not supposed to put you in a position where you're like, 500, I think we should be buying a $900,000 house. It's more of my information back to my agents is, look, the top end is 450. So if you feel like it's a multiple counter situation where we're going to have to rebid above 450, don't do it. You know, that's our true ceiling. A lot of times too, like Melissa's saying, buyers are looking to getting sellers to pay closing costs now. And it's actually a good market to do it in because we still appraise. A lot of times the way we set up, I just want to take one more minute. Has anyone not drafted a contract with seller credits? Okay. Most of you have. I think Steph has too. She's not raising her hand. Are you raising?
Non-recurring closing costs.
Yeah, so typically in this market, what's happening is whatever you want to pay the seller for the house, you need to add more on top of that to get a credit back from the seller. Yeah, so like if I know, this would be a great time to know from your lender, what are our closing costs? Because I don't want to get more of a credit than what our costs are. $8,000, I'll tell you. Okay, we think we can get the house at $490. We want to draft a RPA with a price of $498 is what our offer price is. And down at the bottom on page 1, there's actually a section where you can ask for seller credits of $8,000 to go towards recurring or non-recurring closing costs. I'll tell you what those are in just a second. But essentially you're saying, look, we're going to pay you more at the close of escrow. Just give us the $8,000 extra we paid you. You still get $490 for the house, and you go on your merry way, pay off your expenses and whatever you have.
So you're basically just rolling those fees into the loan so so nobody has to come up with it out of pocket.
Correct. The buyer will not have to come out of pocket today. What they will though is they're going to pay higher property tax, right? They're paying $8,000 more for the house. That's going to get listed with county or the assessor. They're going to have about an $8,000 higher loan because they only have to put whatever percent down on that new $8,000. And truthfully, they're going to have some more long-term expenses. For every $10,000 that they get as a credit, that's $60 more a month. Okay, so what we have to do is a break even. I mean, my job is to give them these financial calculations. Look, you're getting $8,000 today and it's only costing you $60. That's going to last you over 100 months. think it's math, or right
Are you
around.
amortizing that over what 30 years?
They would amortize the $8,000 over 30 years, but then they would look at, like, every month I'm gonna spend $60 more, $60 more, $60 more, and I got $8,000 today. What's the value of that to me? Oh, I'm probably not even gonna be in this house for 7 years. Looks like 7 years down the road, I spend my $8,000 over $60 a month. So that's worth it to them. Okay, they can use that seller credit, right? Why I use the words specifically recurring and non-recurring is a non-recurring closing cost is a one-time fee. That's an escrow fee, a bank fee, a recording fee. That doesn't happen every month after we close. That just happens at the time of closing. A recurring closing cost are prepaids. If you're not sure what prepaids are, that's the impounds and the escrows that we have the borrower set up their account. So right now, if you close in September, it's 9 months of property tax that the borrower has to give escrow, so that when we close, that goes over to their new bank and sits in their trust account that they get to use to pay property tax, other things. 9 months of property tax on a $400,000 house can be $4 or $5 grand. If you just write seller credit $8,000, then escrow doesn't know what to apply it to. They think they can only apply it to the one-time closing cost, the non-recurring. You want to put recurring and non-recurring, it solves all your problems. It basically means $8,000 is going to go to everything until $8,000 runs out. And if $8,000 runs out, that remainder is for your buyer to bring to closing.
That's in reference to title transfer fees, anything, property tax, anything in that time frame that escrow.
Except for points. You cannot buy down points.
No, you can. You can. You can buy, origination fees are a non-recurring fee, so you can do that. What you can't do.
With an FHA?
Yeah.
Oh.
Yeah, you can buy that down if you have leftover, you can. One last thing, this is great. Even escrow agents don't know this. I think usually they know, but escrow has to be told to do things, right? They can't make up decisions. Their job is to take orders. That's not like rude, it's just their job.
Mutual third party.
Yeah, what do you want me to do? So if you have an excess, Melissa, you can actually put up to $5,000 towards what's called a principal reduction.
Okay, hold on. I'm writing this down.
Yeah.
No problem.
You said up to 5,000?
Up to 5,000 is the maximum. Principal reduction is usually, so there's these times, Ben, when you got like $2,800 left over. You got too much credit.
Yeah.
What do we do?
Apply towards the principal.
Yeah, so we just throw it back towards the loan that they just got. We just shave it off. Now their payment's going to stay the same. That just comes off the backside of the loan. So
that's not but you're not buying down a point by doing that.
No. We're talking two different things. Yeah, you can buy down a point. So one of the things I usually look at first, Melissa, is again, how long are we going to live in this house? 3 years? Why buy down a point? Let's pay down the principal because we're going to sell it in 3 years. If we're going to live in this house for 15 years, let's see what $2,800 gets us. Oh, it takes your payment down $45 a month. Let's do that. Because when you buy down the principal, the bank just takes it off the backside. They don't make your payment smaller. That's because already the CD is drafted, you already signed the loan docs and all that stuff. It's just when there's extra found out at closing. So if you ever get a weird call on those last 2 days where you're like, I'm about to get paid, when is this thing gonna close? Hey, we've got extra closing costs. Can you apply it to the principal reduction, please? So the lender's supposed to be the one that tells escrow that, but if you get in a weird conversation with the lender's probably gonna call you. Hey, we got a small issue, there's a little bit too much closing cost. Maybe we can get the insurance agent to raise his premium and we'll pay more for it.
Well, can't they just walk with their money?
No, absolutely not.
They cannot.
No. I'll tell you why. You know the answer to this, Melissa?
No, but I couldn't hear his question. Could you repeat the question?
He said, why can't they just walk with their money?
Oh, no.
Because that looks like it ate into what your deposit was. You have to have 5% of your own money.
Okay.
You have to have 3.5% of your own money.
So you have to apply it towards a loan or towards.
Otherwise, that loan is not sellable. Okay. Yeah, so we can apply it towards the backside of the loan. We can give you a new closing cost, which would be a point. We'll pay that off, and then in turn, your loan gets smaller.
Okay.
Yeah. Usually when it happens after they've signed, you can't buy a point then. You're out of, I mean, then you'd have to tell the seller, hey, we're gonna go back and sign new loan docs. Really sorry. And technically, the lender can do a new CD because that's an agreed upon fee and it benefits the borrower, but they have to do a new CD, wait 3 days, sign new loan docs, then fund, then close. So you're about a week. If you're early, you can negotiate that. That's why the principal reduction is pretty much in place. It's to solve a problem, but it can only go up to $5,000.
And then in general, we should be focused on closing costs being 1%, calculate 1% of 1.5% of the purchase price for closing costs.
Yeah, you can do 1.5%. I usually do 1.5% of loan amount.
Okay.
Yeah.
And then generally our rates right now are under 4%, right?
Depends. No, right now we're in a, does anyone want to hear what rates are doing or am I boring you all to death?
Yes.
Okay. Rates are not good right now and have not been good for about 2.5 weeks for 3 reasons. First of all, North Korea is not bombing anyone, but today, President Trump just said he's going to sign into executive order that we're going to focus hard on basically targeting North Korea was the language that USA Today used. So that could change, but once North Korea fired that missile over Japan, which was crazy, they totally backed off. So the Dow Jones picked back up. They were less worried about war. When the Dow Jones, traditionally, when the Dow Jones goes up 250, 300 points in 2 days, that's bad for interest rates. The bonds market, funds going into the bonds market, push rates down. When that Dow goes up, inevitably, money is coming out of the bonds market into the stock market, the equities market, and that money leaving the bonds market pulls interest rates back up.
Where are we at today?
Today we're at, I would not be surprised if 4.25%, no cost. I just did a second home at 25% down and the people had 750 credit scores, great scores, and a 4 and an 8 cost them about $1,000.
4 and an 8 cost
4 and an 8. So I'm not getting 4 right now. That 25% down, that's a good chunk down. That should yield, a week and a half ago, that was yielding below a 4% interest rate.
So that was a conventional loan.
Conventional Fannie Mae loan. Yeah, they've got a 48% debt to income ratio. They've got a house in Martinez, California, and they're buying one here in Los Osos. And I'm working with Alan Deckles, the buyer's agent. He's a Remax Gold agent. And, you know, he found him a great deal. But the point is, you just never know when you're going to lock. You know, we weren't sure. These are 30-day locks, these quotes I'm giving you, which means we got to close escrow in that timeline. I've got to fund the loan before the 30 days are up. If I want a 45-day lock or a 60-day lock, I actually have to charge the borrower a 1/4 point in fee to extend it for another 15 days. Because the longer the bank has to lock the loan, the more risk that is to the bank.
Why is there so much risk?
What if the market goes up a 1/4 point in 30 days?
Okay.
They're losing the 1/4 point on their money. So I think I think I'll be back, unless you guys don't want me back, in 2 weeks to talk more about when you're in the transaction. When you're in the transaction, how that works, what you should be seeing. I hate when I don't hate when agents call me. I hate when they have to call me. I've set up a system that's like, here's where we're at. Here's what's happening next. Every time my team clicks through our software, it sends out a notice to my agents and our transaction coordinators. So I'll prepare you. I know what's supposed to be happening. I'll prepare you for what that's like so that you can catch when there's red flags. Also, what I'd like to say just before we're done is I'm hoping to get your guys' emails, not because I want to put you on a drip campaign, but because I want to send you the 2 most important things that I see agents not ask their clients openly before they send them to a lender, and that's credit questions and cash to close. So I'll give you a derogatory chart that you don't need to be a whiz on, like, well, actually you had a bankruptcy, you can't get a loan. That's not your job, but to actually bring up the conversation, like, have you?
5 years for bankruptcy,
4.
4 years for bankruptcy, and foreclosure was
7.
7. Okay.
That's for conventional. Now, if you go FHA, government.
2 years for
2 years for foreclosure.
with 20%,
No,
25%.
no. The percentage down doesn't matter.
Really?
FHA is 3.5. Yeah. Percentage down doesn't matter. It's 3.5% down
Oh,
foreclosure for FHA, and you've got me jumbled up now. So so I'll send you this chart. It says it all. And then the real question about cash, I don't know how you bring that up, but I would just ask them, a really good question is like, have you guys saved up enough that you have an emergency fund and be able to put money down? That's without them asking, how much money you got? If they say yes to both those, then they probably are ready to meet and have enough cash to close. If they say no, like, no, we haven't really saved money down, but we do have, they'll tell you, because they always try to defend themselves. We have kids, we only saved about $6,000, but my parents want to give us a gift. That's like the little sirens you go off in your head. We have a buyer that normally wouldn't be qualified, but because of her parents or his parents' gift, they're ready to go.
how much can you give up to?
You can, that's a great question. Let's do this. I'll send you. So his question was, how much can you gift up to? I don't know how many times you've heard this. CPAs will say, oh, the max is $14,000 per child, per parent. So people come to me and say, oh, we can only give you $28,000. That is not true. That's an estate tax guideline. You can gift 100% of the down payment. You can gift whatever they want to put down. It could be 100% parents' money. It doesn't matter. In the mortgage world, if those assets come from a relative, uncle, aunt, brother, sister, that's a viable gift. They have to sign one sheet that says this money is not a loan and will not be repaid at the close of escrow. You cannot get a gift from your broker.
You can't use mattress money.
No, yeah, but that's a definite. But you cannot get a gift from someone that's not related to you. That's not a gift.
Okay.
So what do you guys say I wrap up? Do you have any other questions?
That's great.
Stephanie, you're still awake. I didn't put you to sleep on the couch.
No, I have a little interesting information.
Ladies at home, one second. Ladies at home, are you good? Are you ready to turn me on?
Yes, thank you. Thank you. I learned today.
Thank you. I appreciate your time.
Thanks.
You guys, sorry.
Yeah, my wife works for Shea Homes out at Trilogy, and
I'm friends with Preston.
Oh, he's doing back surgery today.
Yeah.
It sucks. I hate back surgery. I have all these friends that are getting back surgery, and I'm struggling. I've been struggling with my back, but it's really good now because I'm listening to exercises and whatnot that I need to do. But nevertheless, right now they have escrows that are not closing, millions of dollars in escrows because PG&E cannot provide them with electricity. PG&E is sending not all of their, but a majority of their help back east. So it's having a direct effect on that development. I just found that really interesting.
Yeah.
It's like, wow, there's some serious money involved there.
Yeah, if a house is deemed uninhabitable, we cannot close escrow, meaning if they don't have electricity, water, or gas.
It's just, I listen to it and I'm like, oh, that's not a good thing, when you're in business to, with lending and rates you're talking about within a certain amount of time.
That's correct.
Rate can adjust when you have all these buyers in escrow and now you're pushing back escrow.
You can't just turn on the electric.
No, they can't, they're not.
They won't go out to do the site visit to open the account.
Gnarly.
Well, sometimes it was an issue with gas too. You can't get it out in time.
Right.
And you can't close.
Right.
So do you do loans for them?
I work with Drew, so they don't do government loans at all. Shea only. So Shea has their own bank inside of their huge company. They're a developer, and so they can do the vanilla conventional loans, Fannie Mae and Freddie Mac, that don't have any weird derogatory. So they offer about 80% of their home buyers financing. The government ones they do not do. So you got a lot of veterans that want to move to this area. Naturally, they want to use the VA loan. It's the best loan out there. 0 down, great interest rates, no MI, and they can't do it, so they call us. And I'm sure they call other banks too, but we have a good relationship with them.
Over 80% are all cash.
Yeah.
So and they're like third, fourth homes. So it's some people, they have $10 million.
Right.
It's like
yeah.
they're not looking for a loan.
They're not. Yeah, we don't have a good partnership.
But I'd be my pleasure to refer people to, by all means. I'd like to get a call.
Sure. I'm gonna run to the car and grab those. I brought a bunch in.
Nice.
Our bunch with me, and I want to make it so that there's no your questions in exchange for business. If you guys want to ask me questions, my goal over the next 6 to 12 months is to be I want more people to come to these because you guys are like, I learned something. I want more people to get value from what I have to offer. This business is not easy. There's a lot of little things that can go wrong. But if you have a good partnership with a lender, whether they're the actual lender or just can answer your questions, you can put people in the financing world in awkward / dangerous positions where they need to answer you correctly. And that's what I think. I say that because I want you to have the power to know if they're being truthful or not.
Yeah, time is so valuable in any business. And when you feel like you're wasting your time with somebody, it's like, well, what am I doing?
That's my biggest challenge is getting these people to go and get
Is it?
pre-approved. So that I don't.
I have a
they're certain
suggestion.
I'm not showing the property.
I did this back in the day when I was a realtor. Obviously, it worked a little, and it did. I wrote a couple offers, but up in San Luis, we did at one point new home buyers seminars. That might be something that I'm not against working with a new home buyer because they're still my demographics that. I'm always around younger people, and I'm sure we all come across younger people that are first-time home buyers, newlyweds, whatnot, and having a little seminar where there's light food and light drinks that come, and then you also invite them,
and our title companies. Our title companies will gladly pay the bill for that stuff. I've done those sometimes.
A little PowerPoint presentation, just to settle their nerves, because I've worked with them before, and they're very anxious, wanting to know if they're making the right decision. Numbers are newlyweds and new first-time home buyers. It's an issue. And
you're dealing with a lot of dynamics for sure. Usually,
it's a hard sell.
People. I'm 37, so people that are in the 25 to 32-year-old range, they're in the last 3 months, last 3 years, got married or getting married, they're getting this house because she is pregnant, or they want to get dogs, they're trying to grow their family and they want to have something. And usually somewhere in there, I think you probably experienced this, the mom or the dad is also poking their head in, giving them advice, because truthfully, people have a preconceived notion of us, real estate agents, bankers. They're just trying to get money.
They'll tell you anything to make you sell happen. But that first-time home buyer seminar, that can break down walls of stereotypes, and it could get you a new client. Where
I'll give you some information.
Yeah. And I also want to get information on that on my property with that drawing. I want to get more information.
And actually, that's a
got me
question
thinking
I
about
could ask him. The drawing is ADUs. As a lender, do you count that as income for an ADU?
On a primary residence, if you cannot count income on an ADU, auxiliary unit, we can count income if it has its own water meter and its own address.
Okay.
And it's considered a two-unit.
But you can't count it if it's permitted, correct?
I can't count the income from that unit to qualify the borrower. You can't count income on a primary residence on a purchase transaction,
Even if you have a renter in there, you can't count.
right?
that.
Because it's auxiliary. It has to be a duplex or considered a 2-unit. And the way you get it to be 2 units is it has its own water meter, and usually then it has its own address.
Right.
Here's why, okay? So technically, that person was in there before our borrower moved in. We're buying the house.
Right.
So technically, the main structure of this subject, the main structure is going to be changing out ownership. Was to keep that buyer from kicking them out.
Okay, got it.
And secondly, if they bought it and then left, that most cities won't even let you rent the auxiliary unit unless you're living in the main structure.
That's right, for an
Municipalities have an ordinance that says you can rent it if you live here, but you can't leave and make these both rentals.
Oh, because it has to be your primary residence.
The auxiliary is a primary residence, and the only reason you get to use it as a tenant-like facility, or nowadays Airbnb, is because you're dwelling there. If you leave, there's nothing that says you can't leave other than the law, and if they catch you.
Mine's permitted, my second little guest house is permitted with the city of Arroyo Beach as a workshop.
But do you rent it out?
Absolutely.
So you may be.
That's what we were, I know.
You might be.
I know exactly what I'm doing.
Okay.
Yeah, I've been fighting with the city of Arroyo Beach it's only been rented out to my family for, now I own property, but for like the past 45 years. So it's
Could we get that, just do that as an ADU then?
But my big thing with the city has been, they will not separate that 7,500 square foot lot, and they will not, they won't, they won't. But I might have a fighting matter here, because there is a property catty corner on 13th and Newport that they're filing with the county and the city.
305 Newport.
Yeah,
That's not gonna work.
They want to split
That's not happening.
If they split
Why
it,
would it happen?
that will give me leverage to fight.
They're not happening.
Why won't it happen?
Because,
I'm
well,
curious. I know.
I think
my
Off-street
fiance is a
parking.
contractor,
Right.
and he went to the city and they let him to believe that they could do it, that he could do it. But then they came back and said, you can't do it, and it has to do with something about the garages. I mean, it was given you had to make that first house there that faces Newport. You had to have a garage or a carport. But there was something else, and I can find out exactly. But it was like, and that's why it's going out of escrow twice.
You can't do PUDs?
What do you mean?
Planned urban development, you can't put 4 dwellings and have one.
No, you cannot put.
You can't put, and then have on that square lot.
There has to be.
It's not zoned that
It's
way.
not zoned.
Oh, okay.
You have to have a
It's-
certain amount of land acreage per footage.
That population density.
So you can have 2, which it does have,
Right.
but splitting the lot, and I believe that's, I heard,
Well, it's
that's
going
one
up
reason
in
why
front of
one of them came.
The city council, they're already proposing.
Sure.
I was booked on it. I'm all excited about it,
So
because
that's-
if they give them that to split
When's that
that,
on to city
go
council?
drive by there, look at it. I'm all hyped about it, because then that'll give me leverage to split my property and I can sell off.
When is it going to city council?
I want to say, by this month. But drive by and look at it, it's a proposal, they haven't staked on that property. I know they
Oh,
own the property.
really? Okay, because Roger had checked with the city, this was as of last week.
Yeah, I'm with you, I don't think they're gonna allow 2 homes to go on that property, because it has a lot to do with the density, population density, as well as off-street parking, and, they told me that they wanted, to split my property, there'll be a lot, that's tying into, the water main, electricity, a permit to get an ADU. Yeah.
And not all ADUs have to be permitted either, you don't have to be.
Because won't that bring value to my property?
Well,
See, I'm kind of
it's a
losing.
perception, because, right, it's kind of a perception whether or not it's going to be value, because you're not going to count it when you go to sell.
They're not going to give me any assessed value on
No,
livable
for
square
having
footage.
income, because it's your personal, it's considered your personal risk.
So basically, I would be limited
It's not
to a
good.
cash buyer. If I were to ever sell that property, I would try to market it to a cash buyer, because to get a lender to loan on a property with a guest house that brings in, all this money, you can't declare the money, what he's saying.
You can't
So
declare
that
it.
limits your money, your buyers to a cash buyer.
Well, but no, but you can still do it. Let's say I want to buy your house and I know it's there and I'm willing to pay more for it. It's not gonna be assessed at that. Why is what you're saying with cash? The house will
appraisal will
still
come
be
in.
assessed.
The appraisal will come in.
Well, I don't know.
I guess the
I
loan
don't
to
know
value
about
would
that.
have to,
Exactly. I don't know that the appraisal will come in because they're gonna appraise it as a workshop
they didn't give me shit for appraisal.
for a workshop.
No, they didn't give me nothing.
Yeah, they're not gonna count the square footage as livable space, which brings it more. But a workshop that X amount of square footage is not that large, is gonna make that big a difference, like you were saying earlier, price of the house.
Thanks, Mike.
So that house has gone out of escrow twice in this first